Let me show you why students finally understand accounting equations after watching this.
Welcome to this explainer. If you're involved in business, you probably know your way around a balance sheet. But today, we're diving into the absolute, undeniable mathematical logic that underpins it all, the fundamental accounting equation. By the time we wrap up, you'll be able to look at a totally jumbled pile of financial numbers and instantly spot the perfect logic hiding right underneath. It's basically a superpower. But before we get into the nitty-gritty numbers, let's start with a big question. How do businesses actually know exactly what they're worth? I mean, whether we're talking about a massive global corporation or just that small local bakery down the street, they definitely don't just guess. No way. They rely on a specific, rock-solid mathematical rule that makes sure literally every single dollar is accounted for. And that rule? Well, that's exactly what we're going to explore right now. Okay, let's dive into this. Here is our roadmap for today. 1. The core equation. 2. ALC definitions. 3. The labeling system. 4. Calculating missing capital. And 5. Avoiding mistakes. Section 1. The core equation. The ultimate balancing act. Here it is, the big one. Assets equal capital plus liabilities. A equals C plus L. Think of this equation like a perfectly balanced scale. Because of what accountants call the dual effect, every single transaction a business makes impacts at least two accounts. So if the left side of this scale goes up, the right side must also go up. Or, something else on the left side has to go down to compensate. Basically, no matter what happens, this equation must always balance. Moving on to Section 2, ALC definitions. Meet the characters. First up, assets. Put simply, assets are everything the business owns. These are the resources the business controls and uses to operate. We're talking about the cash sitting in the bank account, accounts receivable, which, by the way, is just money customers owe the business, as well as physical stuff, like that massive mountain of inventory sitting in the warehouse, or the heavy equipment used to actually make the products. The rule of thumb? If the business owns it, it's an asset. On the flip side of our scale, we have liabilities. These are exactly the opposite, the unavoidable reality of doing business, right? Liabilities are everything the business owes to outsiders. For example, if the business took out a loan from a bank to buy a new delivery truck, that loan is a liability. Or if they bought supplies on credit from a vendor and haven't paid them yet, that's called accounts payable, and yep, that is firmly a liability. They basically represent external claims on the business's resources. And finally, we have capital, which you might also hear called equity. This represents the owner's personal investment in the business. Another really good way to think about it is that capital is what the business owes to the owner. It represents the total resources the owner has invested and actually left in the firm. Now, within our assets, we do need to make a quick distinction between non-current and current assets, and this is based entirely on their lifespan and liquidity. Non-current or fixed assets are those long-term resources bought with the intention of using them for a long time, things like land, premises, or heavy machinery. Current assets, on the other hand, are highly liquid and short-term. They're either cash itself or things we expect to turn into cash pretty quickly, like inventory, cash in hand, or prepayments. Recognizing this structural difference is absolutely crucial for organizing the balance sheet correctly. Section 3, the labeling system, your tactical hack. Okay, I absolutely love this one. I call it the ACL labeling system. When you're faced with a massive list of business balances, don't just start adding numbers randomly. That is exactly how mistakes happen. Instead, just follow these simple steps. 1, read down the list. 2, write a letter A next to anything the business owns. 3, write C for the owner's capital. And 4, write L next to anything owed to outsiders. This little tagging game drastically reduces your cognitive load. Honestly, by sorting the data first, your mathematical formula will basically write itself. Section 4. Calculating missing capital. The mystery. So what happens when capital is a total mystery? Well, we solve it by simply rearranging our foundational equation. If assets equal capital plus liabilities, then capital must equal assets minus liabilities. It's just simple subtraction. Let's look at a case study from our sources. Thomas Timberland starting his restaurant business. Following our tactical hack, first we total his assets. He's got stoves worth $1,500, tables at $850, a refrigerator for $2,500, plus cash at the bank of $5,500, and a few other items. All those A labels add up to a specific number. Step 2, we total his liabilities. Interestingly, in Thomas's case, he has 0 liabilities. He doesn't owe outsiders a dime. Step 3, we just subtract those liabilities from his total assets. And boom, the mystery is solved. Thomas Timberland's missing capital is exactly $14,745. By carefully totaling his owned equipment and cash and subtracting his zero liabilities, we find the exact value of his personal investment. I mean, it is incredibly satisfying when the math just snaps into place like that, isn't it? Section 5. Avoiding mistakes, dodging the traps. Now, what's really interesting about this slide is that it highlights the single most confused pair of terms in all of accounting: accounts receivable versus accounts payable. Seriously, do not get these mixed up. Accounts receivable is an asset. These are the customers who owe you money for goods you've already provided. You have a right to that cash. Accounts payable, on the other hand, is a liability. These are the suppliers that you owe money to. Misclassifying these two is literally the fastest way to break your balance sheet. Just remember, receivable is an asset, payable is a liability. And that brings us to the ultimate cheat code to guarantee your math is correct. The sources strongly recommend performing what they call a balance check. Once you calculate that missing piece of the puzzle, whether it's missing capital or, say, a missing inventory value, don't just assume you're right. Actually, scratch that. Never assume you're right. Plug that new number back into the original formula. Add all your assets together again. Then, separately, add your capital and liabilities. Those two totals must be exactly the same. If they aren't, you've missed a classification and you definitely need to review your labels. Well, we've covered the core equation, the ALC characters, our labeling hack, and how to balance the scales perfectly. But let me leave you with a final, provocative thought to test your new skills. We know every transaction has a dual effect, right? And the scale must always balance. So, what exactly happens to this scale if an owner takes cash out of the business for personal use? What goes down and what must balance it out? Think on that. Thank you so much for joining me today on this explainer. Until next time, keep those equations perfectly balanced.
As always, the link for this study tool is in the description below. Let me know what you think in the comments.